In 1956, the Dow Jones Industrial Average was climbing. My fund had beaten the market every single year for 2 decades. 20% annual returns on average against the market's 12. My investors had not lost a dollar since 1932. The partnership was managing roughly $12 million. Warren Buffett, the best analyst I had ever hired, was sitting 30 feet from my office door. And I was 62 years old, and I closed the fund. I dissolved the partnership. I walked away from Wall Street entirely, not because the market had turned against me, not because I was tired of winning, not because I had run out of ideas or lost faith in the method, because I had finally begun to calculate something I had been ignoring for 40 years. That calculation is what I want to talk to you about tonight. My name is Benjamin Graham. I spent the better part of my life teaching investors how to think clearly about money, how to separate price from value, how to read a balance sheet without being deceived by it, how to stay calm when the market is doing everything in its power to make calm feel impossible. Those are the things I am known for. What I am considerably less famous for is how long it took me to think clearly about time. Those are not the same subject. And if you are past 50, the difference between them may be the most important financial question you will ever face. I did not arrive at that understanding easily. It cost me something to get there, several things actually. And I think the path, the losses, the long rebuilding, the slow recognition of what I had been measuring and what I had been completely overlooking, I think that path is more useful to you than any formula I ever wrote. Tonight, I want to leave you with 3 things I wish someone had told me before I turned 50. The first is what the crash of 1929 taught me that no bull market ever could. The second is what I was actually calculating when I walked away from Wall Street at 62, because it was not what most people who knew me assumed. And the third is how the arithmetic of investing must change when time, not return, becomes the thing in shortest supply. Not the philosophy of investing that remains constant. The arithmetic, the specific numbers, ratios, and decisions that look entirely different at 60 than they did at 35. Let us begin in January 1929. There is something you need to understand about Wall Street in the late 1920s before I tell you what happened to me. Because without that context, the losses sound like simple bad luck, and they were not simple bad luck. They were the predictable consequence of a collective delusion that I, along with almost everyone else, had allowed myself to share in. The decade that preceded the crash was unlike anything that had come before in American financial history. The economy had grown steadily since the end of the Great War. New industries, automobiles, radio, consumer goods produced at scale were generating genuine wealth, genuine earnings, genuine reasons for optimism. And into that environment of legitimate growth, something else crept in. The belief that growth would continue indefinitely, that the old standards for valuing a business had become obsolete, that the new era of industrial productivity had permanently changed the relationship between price and earnings. I did not believe that. I had written explicitly in lectures and in published work that the old standards had not become obsolete, that a stock selling at 20 times earnings was expensive relative to history, regardless of the story being told about its future. I knew that. I argued it publicly. And I was also running leveraged positions in a bull market that had been rewarding leverage for 8 years. I tell you this not to confess a contradiction, but to illustrate something that I think is one of the most important and least discussed facts about investing. Knowing the right principle and living by it are 2 entirely different skills. The gap between them is not filled by intelligence. It is filled by something harder: to acquire the genuine felt in the bones conviction that the risk is as real as you know it to be. I had the knowledge. I did not yet have the conviction. The crash gave me the conviction at a price I would not wish on anyone. I was 34 years old. The partnership Jerome Newman and I ran had $2.5 million under management. I had signed a 10-year lease on a duplex apartment overlooking Central Park at $11,000 a year. I had domestic staff, a valet who gave me a daily massage, In good years, I was earning what today would be something close to $10 million. I was, by every measure, I knew how to apply a success. The measure I did not know how to apply was the one that was about to matter most. The bull market that ran from 1921 to 1929 had lifted the Dow Jones Industrial Average by 450% over 8 years. I want you to hold that number for a moment because it explains something essential about the psychology of what followed. When a market rises that far, for that long, something happens to even the most disciplined investor. Not suddenly, gradually, almost imperceptibly. The gap between what you know intellectually, that markets correct, that prices overshoot, that leverage cuts both ways, and what you believe emotionally, that conditions are different this time, that growth will continue, that gap quietly closes. You stop truly believing the downside is as real as the upside. You begin operating as though the risk is theoretical rather than actual. I was not immune to this. I had written about it. I had lectured on it at Columbia. But I had been carrying substantial leverage positions, long holdings, against which I had borrowed in a market that had rewarded exactly that behavior for 8 consecutive years. And the leverage that magnified the gains of the bull market became, with very little warning, the mechanism of a loss I was not prepared for. Not intellectually unprepared. Something deeper than that. I was not emotionally prepared for it. There is a difference, and it matters enormously. By the end of 1929, the fund was down 20%. Most of my investors were relieved the Dow had fallen 17% that year. Relative to the market, we had done well, and I heard myself described more than once in those final months of the year as a financial genius for not losing more. I accepted the compliment. I should have been more alarmed because 1,930 came, down 50%, then 1,931 down 16, then 1,932 down 3. In the year, the Dow itself bottomed at 41. By that point, only 30 cents remained of every dollar placed in my care in January 1929. The Dow, over those same 4 years, had lost 80% of its value. So by relative measure, I had outperformed the market by 10 percentage points. And at the same time, 70 cents of every dollar was gone. Both of those things are simultaneously true. The arithmetic holds them both without difficulty. The psychology could not. A man who loses 70% of what he manages does not simply lose money. He loses the version of himself that believed he understood risk. Not the textbook definition of risk. I could recite that in my sleep and did regularly to students. The felt sense of it, the understanding arrived at through experience rather than theory, that what you have built can disappear, and that the market owes you no recovery, no symmetry, no justice whatsoever. That understanding, for me, arrived only when the losses were real and extended and seemingly bottomless. There were investors who withdrew capital during those years. I do not blame them. One of them, a man named Bob Maroney, as composed and steady a man as I ever knew, reportedly broke down in tears when disclosing to his lawyer the near total loss of a fortune that had been well over $1 million. I think about that still, not as a story about the market's cruelty, but as a story about the distance between what we believe we can tolerate and what we can actually tolerate when the losses are compounding downward month after month with no visible floor. What saved the partnership was not genius. It was stubbornness, the loyalty of a small number of investors who stayed, and one man, Jerome Newman's father-in-law, Elias Rice, who put fresh capital into the fund at the very depths of 1,932 when almost no one was doing anything of the kind. I have thought about that decision many times. One person's willingness to add capital when everything felt most desperate changed the trajectory of everything that followed. He was not being reckless. He was in his own quiet way applying the principle I had spent years trying to teach. When price falls far below value, the correct response is to buy, not to sell. He simply had the composure to do it when doing so felt most wrong. I rebuilt the fund through the mid-1930s the same way I had built it originally, by finding businesses selling for less than their demonstrable worth buying them with a margin of safety wide enough to absorb further error and waiting. The difference was that after 1932, I did this without leverage. Not as a rule I had adopted philosophically, but as a lesson I had absorbed at the level of instinct. The margin calls of 1,929 through 1,931 in the moment when borrowed money becomes an obligation to sell exactly what you should hold. That experience does not leave you. It becomes part of how you see every subsequent position. Something else happened in those rebuilding years that I think deserves a moment of attention because it speaks directly to what I want to tell you about investing after 50. As the losses were being rebuilt, and as the method was proving itself again in the recovery, I noticed something about my own emotional relationship to the portfolio. I had become, if anything, more conservative, not just in the positions I took, but in the meaning I attached to what the fund was doing. Before 1929, the portfolio's performance was something close to my identity. The good years were my good years. The bad years were personal failures. After 1932, that changed. The fund became a tool, a very effective tool, one I was proud of and committed to, but a tool nonetheless, something that existed to produce a result, not to define me. I did not fully understand the significance of that shift until 1956, but it began there, in the rubble of the early 1930s. And I think it is a shift that many investors, particularly those who have been very successful, whose identity has become entangled with their performance, need to make deliberately if they have not made it naturally. The portfolio is not you. Its performance does not measure your worth. When you know that in your bones, the bear markets become more manageable. Not painless, more manageable. By 1936, the partnership was rebuilt. We had reorganized into the Graham-Newman Corporation, and from 1,936 until I closed the doors in 1956, the fund never lost money. 20 years. Average annual returns of roughly 20% against the market's 12. A $10,000 investment made in Graham-Newman in 1936 became approximately $155,000 by 1956. The same $10,000 in the broader market became roughly $100,000. That $55,000 difference was not produced in the good years. In a rising market, almost everyone looks intelligent. The gap was produced in the bear markets, in the corrections, the periods of declining prices, the moments when holding felt irrational and selling felt like sanity. The gap came from not selling what the analysis said to hold and from buying more of what the fear said to avoid. That discipline did not come from courage in the moment. It came from having survived 1,929 through 1,932 and understanding in a way I had not understood before what decisions made from fear actually cost. But, and this is the thing I want you to carry, I did not yet understand, even in 1936, what I had actually been missing. I understood how to protect capital. I had learned margin of safety, the importance of the gap between price and value, the necessity of avoiding leverage that could force a sale at the worst possible time. I had learned all of that. What I had not learned was what capital was for. That sounds like a philosophical statement. It is not. It is a practical one. Capital is a means to an end. The end for most people is some combination of security, freedom, and the ability to spend time on what they find meaningful. But when capital accumulation becomes the primary activity of a life, when the building of the portfolio crowds out the things the portfolio is supposed to enable, the means has displaced the end, and no balance sheet will show you that displacement. It is invisible to arithmetic. You have to look somewhere else to see it. I did not look somewhere else for a long time. Most of the people I admired most were not looking either. We were all very busy looking at the balance sheets. Let me take you to 1,956. The market was in good shape. The Dow had recovered from its depression lows and was moving higher. The fund was sound. Sitting in my office was Warren Buffett, the young man from Omaha who had come to my class at Columbia, received the only A+ I ever gave, and then pursued a position with me so persistently that I eventually yielded and hired him at $12,000 a year. Even then, at that early stage, he saw things in businesses that other people simply missed. Anyone watching from outside would have said, "Keep going. You are winning. The method works. The fund is performing. Why stop?" I closed it anyway. The practical reason was that I could not find a suitable successor. Graham Newman stood for something specific, and I was not willing to hand that name to someone who might, over time, erode what it meant. So I let it end cleanly rather than let it drift. That is true, and it mattered. But the real reason was something I had never put through any formal analysis, and I want to be honest about what that means, coming from me. I had spent my career arguing that the failure to analyze, to look clearly at facts, to separate what could be known from what was merely hoped, was the root cause of most investment mistakes. I believed that. I still believe it. And yet here was the most important decision of my professional life, and I was making it on the basis of something I had never quantified, never compared against alternatives, never subjected to the same cold scrutiny I applied to a balance sheet. The reason was not laziness. It was that the thing I was calculating, whether to continue or to stop, whether the next 20 years of running money would be better spent in some other way, that calculation involved inputs that no formula handles well. It involved a kind of value that does not compound in ways you can grasp. I am aware of the irony. The man who built a career on the power of arithmetic was making his final major decision in a domain where arithmetic was largely helpless. I do not resolve that irony. I simply report it. My father died in 1903 when I was 9 years old. He was not yet 40. His death left my family in poverty, and it left me with something I carried for decades without fully examining it, a fear of financial collapse so deep that it shaped everything I did on Wall Street, mostly for the better, sometimes in ways I could not see clearly from the inside. The drive to build, to protect, to accumulate, I understood it as prudence. It was also, I think, fear. The fear of the boy who watched his family's circumstances collapse and decided, somewhere below conscious thought, that he would never let that happen to himself. By 1956, I was 62. I had outlived my father by more than 2 decades, and I had spent most of those 2 extra decades in an office, applying mathematics to balance sheets. In writing, I did privately around that time notes that were never meant to be seen by anyone. I described myself as remote and inaccessible to the people close to me. That is a painful thing to write about yourself. It is more painful when you sit with it long enough to recognize it is accurate. I had built a system for analyzing businesses that was in many ways a genuine achievement. I had not built anything equivalent for the other parts of my life. And at 62, the asymmetry of that became impossible to keep ignoring. There is a moment in every long card game when the question is no longer whether you are winning. It is whether the game itself is still worth playing. Not whether you could win more hands, perhaps you could, but whether more hands is actually what you want from the remaining hours. I had spent my career teaching investors to ask one question above almost all others: what is this business worth? I had refined that question for 42 years, tested it against the worst markets in American history, written 2 books about it. And sitting in that office in 1956, with a fund that was performing exactly as it should, I began asking a question I had never put through the same rigor. What is this year worth? What is this arrangement of hours and attention and energy actually producing, and for whom? And is that the production I most want from whatever time remains? Those are not the same question as what is this business worth. A business can be valued from its assets, its earnings history, its future cash flows. You can construct a margin of safety around the price you pay and hold with reasonable confidence through the volatility. But a year of your life does not appear on any balance sheet. It has no book value, no earnings record, no dividend history you can consult. Mister, market does not come to your door each morning with a price for it. And because it cannot be quantified, most people, most investors, including for a very long time, may never calculate it at all. They simply spend it the way a careless investor spends capital, without asking whether the return justifies the cost. I dissolved the partnership, moved the family to Beverly Hills, began teaching at UCLA without pay, not because I needed to teach, but because teaching had always returned something the trading never quite did. Not money, something harder to name. The sense that the ideas were going somewhere beyond my own portfolio, that they were being planted in people who would carry them forward in ways I could not predict or control. I went to France eventually. I died there in 1976 in a house in Aix-en-Provence at 82. Nothing in that house had anything to do with Wall Street. So I left. But leaving Wall Street was not leaving investing. I continued investing my own capital for the rest of my life. What I left behind was the obligation to manage other people's money and the identity that had become attached to doing so. And here is where the question becomes yours, not mine. If you are past 50, what should your portfolio actually look like? Not abstractly, in practice, with specific attention to the ways the arithmetic changes when the clock on the wall starts to matter as much as the ticker on the screen. Let me give you something to hold before I answer. A question I want you to carry for a few minutes because I think it reframes everything that follows. The purpose of investing is security. That is not my preference or my temperament. It is the definition I wrote in 1949 in The Intelligent Investor. An investment operation is one that, upon thorough analysis, promises safety of principal and a satisfactory return. Safety of principal first, return second. That ordering is not accidental. It reflects the understanding hard won through experience, not theory that the most important thing investing can do for a person is protect what they have built, and that chasing return at the expense of that protection is not investing, it is speculation wearing a more respectable name. Now, hold that and ask yourself this. If the purpose of investing is security, at what point does continuing to invest in the same way with the same risk profile and the same orientation toward growth over income, at what point does that continuation become the very thing that threatens your security? I want you to sit with it, because the people who most need to hear that question are usually the least inclined to believe it applies to them. In The Intelligent Investor, I propose that a defensive investor should hold between 25 and 75% of their portfolio in bonds at any given time, adjusting the allocation as market conditions change. Never below 25% in either direction. When stocks were cheap relative to their earnings and to bonds, you moved toward 75% equity. When stocks were expensive, you moved the other way. The floor was a hard floor, not a soft guideline. That framework was built for any age. But after 50, the application changes. Not the principle. What changes is what you are trying to accomplish with each piece of the portfolio, and what counts as an acceptable risk given the specific shape of the years ahead. 3 shifts, not suggestions, shifts in the arithmetic itself. The first is from return to income. Before 50, the central question is, how much will this grow? You are building. You have time to recover from mistakes, time to wait out bear markets, time to let the compounding do the work that patience enables. A stock that pays no dividend but is compounding its intrinsic value at 15% a year is for someone with a 30-year horizon close to ideal. The absence of current income is simply deferred income deferred to a future moment when growth will be converted to cash. After 50, that shifts. The question that begins to matter more is, how much will this reliably pay, and can I live on what it pays without having to sell anything to do it? The shift sounds simple. It is not simple in practice. Because the assets that pay reliable income, high-quality bonds, stocks with long uninterrupted dividend records, certain preferred shares, are rarely the ones appearing most exciting in a bull market. They are not the ones being discussed as the plays that could double your money in 18 months. They are, in many ways, the boring assets. And boredom, I will tell you plainly, is significantly underrated in investing at any age, but it becomes genuinely important after 60. An investor who depends on income, on dividends, and coupons that arrive regardless of what the market is doing on any given day is structurally insulated from one of the most dangerous forces in late life investing, the forced sale. A forced sale is what happens when an investor needs cash, and the only way to access it is to sell something possibly at exactly the wrong moment in exactly the wrong market conditions. The investor with a reliable income floor does not face that pressure. The income arrives, the principal stays. Mr. Market's mood on Tuesday morning is largely irrelevant to whether the bills are paid. That kind of insulation cannot be assembled in the middle of a crisis. It must be built before the crisis arrives, which means the time to begin the shift from return to income is not when you need the income. It is a decade before you need it, when you still have the flexibility and the time to build it deliberately. Let me say one more thing about income, because I think it is misunderstood in a specific way. Many investors treat dividend-paying stocks and high-quality bonds as consolation prizes, what you hold when you no longer have the nerve or the time horizon for the more exciting position. That framing has it exactly backwards. Income-producing assets are not the retreat from serious investing. They are the foundation that makes serious investing possible in the first place. They are what allows you to hold your higher-risk equity positions through a bear market without being forced to liquidate them at the bottom. The investor with no income floor and no cash reserves is the one who sells at the worst moment, not because they are unintelligent, but because they have no alternative. The investor with a reliable income floor holds because the income is handling what needs handling and the equities can wait. I propose in The Intelligent Investor that the defensive investor should own shares of leading American companies, companies with long records of profitable operation, moderate debt, a history of paying dividends, and prices that were not excessive relative to their earnings. That is still, in my view, the correct starting point for someone who wants equity exposure after 50 without the volatility that comes from holding speculative positions. The boring companies, the ones that have been paying dividends for 20 or 30 years, the ones that do not require you to understand a new business model or bet on a management team you have never seen perform through a full cycle. Those are not glamorous holdings. They will not be discussed at investment conferences as the bold ideas of the year. They will simply continue to pay quarter after quarter while Mr. Market swings between enthusiasm and despair about everything else. And that steadiness, that predictable, unexciting arrival of income is worth more to an investor over 60 than another 2% of potential upside. The second shift is in how you define a margin of safety. In my early work, margin of safety referred to the gap between what you paid and what the business was conservatively worth. You buy $1 of value for 70 cents. The 30 cents is your cushion against being wrong about the valuation, wrong about the business, wrong about when the market will recognize the value. You are protected not because you were right. You are protected because you left enough room to be partially wrong and still survive intact. That concept does not change after 50. What you must add is a second margin of safety that has nothing to do with price, a margin of safety on time. Before 50, a 50% loss in a serious bear market is painful and expensive, but it is mathematically recoverable. 10 years of continued investment at reasonable returns, combined with the discipline not to sell at the bottom, and most of what was lost comes back. History supports this. The math works. After 65, the same 50% loss carries a different arithmetic. The recovery window is shorter. The investor may not have 10 more years of contributions to help rebuild the base. More likely, they are drawing down the portfolio rather than adding to it, which means a 50% decline is not a paper loss waiting to recover. It is a permanent reduction in the capital from which all future income and growth must be generated. The compounding that builds wealth over decades becomes compounding subtraction when withdrawals continue through a prolonged bear market. This is not a theoretical risk. It is the arithmetic of sequence. The order in which returns arrive matters enormously in the years around retirement. Two investors with identical average returns over 20 years can end up in dramatically different positions depending on whether the bad years came early or late. The one who experiences a severe loss in the first 5 years of retirement while drawing down the portfolio recovers far less well than the one who experiences the same loss 15 years later. The mathematics on this is not subtle, and the appropriate response, the way you build a margin of safety against this specific and very real risk, is by holding enough in income-producing assets that a prolonged equity bear market does not force you to sell equities to meet your expenses. You wait, you hold, you let the stocks recover without touching them because the income is covering what needs to be covered. The third shift is from beating the market to not losing to yourself. I will be direct about this because I think it is the shift that intelligent people resist most strongly. The investor who has spent decades focused on performance, on outperforming benchmarks, on finding undervalued securities, on the genuine intellectual pleasure of being right about a business when the market is wrong, does not easily let go of that orientation. It is part of how they understand themselves. And so they continue past 50, past 60, with the same portfolio construction, the same risk profile, the same performance objectives, because to change any of it would feel like an admission that something has changed, that they have changed. But here is what I observed across many decades of watching investors move through markets. The greatest financial damage in the second half of a life is rarely done by bear markets themselves. Bear markets end. Values that were real before a crash are usually still real after it. A business worth $100 before the market fell to 60 is not actually worth 60. It is still worth 100 or close to it. And in time, the price reflects that. The investor who holds, who has the construction to not be forced out, generally recovers. The damage is done by the decision made during the bear market, the sale at 68. The move to cash at the bottom after months of declining prices made holding feel simply unbearable. The investor who makes that decision does not recover because the assets that would have recovered are no longer in the portfolio. The loss is not temporary. It was realized. It was realized not because the analysis said sell, but because the fear became intolerable. The cure is not courage. I want to be clear on this because it is where most investment guidance goes wrong. Telling investors to be courageous in a severe bear market is a bit like telling a man standing in a burning building to remain calm. The emotional state inside a genuine market collapse, when the portfolios decline 30 or 40%, when the financial news is uniformly terrible, when people you respect are predicting worse to come, that state is genuinely difficult to override by willpower. Walter Schloss, who worked with me and understood markets as well as anyone I ever taught, described how profoundly the experience of 1,929 shaped the psychology of everyone who lived through it, not just for a few years, but for the rest of their lives. A major loss does not leave when the prices recover. It stays. It changes how you respond to the next decline and the one after that. The cure is not courage. The cure is construction. A portfolio built in advance, built so that no single market event forces a sale, is a portfolio in which courage is largely unnecessary. You are not white-knuckling through the decline. You are waiting because the portfolio was designed for waiting. The income arrives. The expenses are met. Mr. Market's despair on any given Tuesday is a number on a screen, not a crisis requiring action. What does that construction actually look like? I want to be specific because generalities are not helpful here. It starts with what I would call a cash and income floor, an amount set aside in instruments that do not decline significantly in a stock market downturn, sufficient to cover your living expenses for at least 2 years, ideally 3, not invested, not working, sitting in short-term bonds, treasury bills, or the equivalent, doing nothing more interesting than being available. The purpose of this reserve is not to earn a return. Its purpose is to remove the scenario in which a bear market forces you to sell equities at the bottom. It buys you time. And time, after 50, is the most valuable thing a portfolio can purchase. Beyond that floor, the fixed income portion of the portfolio bonds, dividend-paying stocks, preferred shares should be sized so that the income it generates covers a meaningful portion of your ongoing expenses. The precise percentage depends on circumstances I cannot know from here. But the general principle is that the more of your expenses covered by income rather than by asset sales, the more freedom you have to leave your equity positions untouched through a prolonged downturn. The equity portion, remaining above that income layer, can and should continue to be invested in businesses you understand at prices that represent genuine value relative to earnings and assets. That does not change after 50. What changes is the sizing. You are not concentrating in a handful of positions the way an investor with 30 years ahead might reasonably do. You are holding a more diversified group of companies, each with a long history of profitable operation, each priced within a range that allows you to hold without anxiety when the market marks them down temporarily. I am describing something unglamorous, something that will not generate extraordinary returns in a strong bull market. But here's what it will do. It will allow you to still be in the game with meaningful assets, with your principal largely intact, with your income continuing to arrive when the people who are taking concentrated bets at 65 are counting the damage at 70. That is not a small thing. That is, in fact, the most important thing. The investors who came out of the 1929 to 1932 period with their capital meaningfully intact were not the ones who had the best ideas going in. They were the ones who had constructed their positions so that the crash, however severe, did not force them to liquidate at the bottom. They had margin of safety, they had cash reserves, they had income that continued regardless of what the market was doing. And they were able to buy more at the depths, as Elias Reese did, as I should have done more of, because they had not been wiped out by leverage and forced selling. The same principle applies to the bear markets you will face after 50. You will face them. I cannot tell you when. No one can. But you can build for them in advance, and the building is neither complicated nor mysterious. It is simply a matter of deciding deliberately and in advance that certain assets exist not to earn the maximum possible return, but to ensure that the maximum possible return does not become necessary for your survival. Buy not on optimism, but on arithmetic. After 50, the most important arithmetic is not the price-to-earnings ratio of what you hold. It is the ratio of what you need to what you have, and whether taking on more risk is genuinely necessary to bridge that gap or simply habitual. Whether you are still running the same approach, not because the situation requires it, but because it is the only approach you ever learned. That is an honest question. It deserves an honest answer. And I want to give you one more piece of the answer, because I think it is the piece most often left out of conversations about investing after 50. The investors I watched who made the best decisions in the second half of their lives shared one characteristic that had nothing to do with their investment acumen. They had decided at some point before they needed to what the money was actually for, not in an abstract sense. Specifically, they knew what level of income they needed to live well, what capital base would reliably generate that income, and what lay beyond that amount, the excess, the surplus that continued to accumulate above the line of sufficiency. And having made that calculation, they related to the surplus differently than they related to the core. The core was managed defensively, with income and capital preservation as the primary objectives. The surplus, if they chose to invest it at all, could be invested with more risk, more concentration, more tolerance for volatility, because a loss there would not affect their ability to live as they had decided they wanted to live. The two parts of the portfolio served different purposes and were managed accordingly. I did not think in those terms during most of my career. I managed the fund to maximize long-term risk-adjusted return, full stop. That is the correct objective for a fund manager with a fiduciary obligation to investors who have varying time horizons and varying needs. But it is not necessarily the correct objective for a private investor over 60 who has already won the game in any meaningful financial sense. Winning the game and then continuing to play as though the game is still undecided is a common and understandable mistake, but it is a mistake nonetheless. The question to ask, the one I am encouraging you to put through a real analysis, not a casual one, is what would it take for me to feel genuinely secure, not rich, not ahead of any benchmark, genuinely secure in the sense that my income is covered, my principal is protected against catastrophic loss, and the fluctuations of the market from year to year do not determine the quality of my life. Once you can answer that question with specific numbers, the rest of the portfolio decision becomes considerably clearer. You are not choosing between risk and safety in the abstract. You are choosing between what you need and what you want. And for most careful investors past 50, those are different amounts pointing in different directions. Now let me bring this back to where it is most personal. Mr. Market will show up tomorrow. He showed up today. He will show up every trading day for the rest of your investing life, offering a new price for everything you own, sometimes euphoric, sometimes despairing, always completely certain in the moment, and always ultimately wrong about the certainty. That is his nature. It was his nature before I wrote about him in 1949, and it will remain his nature long after this conversation is forgotten. The question is never what he is offering. You know how to evaluate that, or you are learning. The question, the one that sharpens and deepens with every year past 50, is what you are still trying to prove, and to whom. I have thought about this more than you might expect, given that my reputation rests almost entirely on the analytical side of investing. The truth is that the analytical work was never purely analytical for me. It was also a form of proof. Proof that the boy whose family lost everything when his father died could build something lasting. Proof that clear thinking could defeat the market's chaos. Proof that the discipline I had developed through trial, through losses, through years of refining the method was worth developing. Those are not trivial motivations. They produced real results, but they are also motivations that can persist long past the point at which they are necessary. Long past the point at which the proof has been made many times over, long past the point at which the cost of continuing to prove it in time and attention and presence with people who deserve more of it outweighs whatever marginal benefit the additional proving provides. I am asking you to examine your own motivations with the same honesty you would apply to a company's balance sheet. Not harshly, honestly. Are you investing because the arithmetic requires it, because your financial situation genuinely benefits from the risk you are taking? Or are you investing because it is what you know how to do, and stopping would feel like a kind of disappearance? Both answers are understandable. Only one of them is a financial reason. I have known many serious investors who continued taking risks well past the point where those risks were necessary for their actual financial situation. They had enough. By any reasonable calculation, they had more than enough to live well for the rest of their lives, without the returns that additional risk might produce. And yet they continued, not because the arithmetic required it, because stopping felt like losing. Because the market had become the arena in which they measured themselves, and stepping back from that arena meant conceding something they were not ready to concede. That is not investing. That is psychology in arithmetic's clothing. And it is one of the more expensive mistakes a person can make in the second half of a life, not because it always ends badly, but because when it does end badly, the time to recover may simply not be there. I left Wall Street not because it had nothing left to offer me. The market would have let me stay indefinitely, and there would always have been another interesting situation, another business priced below its value, another trade worth making. I left because I had finally understood, later than I would have liked, that the things the market could not give me were the only things that still mattered. Time with people I had kept at arm's length for decades, the freedom to teach without the pressure of performance, the ability to think and read and write about things that had no ticker symbol and generated no return that anyone could measure. I went to France eventually, spent my last years in Aix-en-Provence. I died there in 1976 at 82. Nothing in that house had any connection to Wall Street, and I was not sorry for it. Let me tell you something about those last years in France that I think is relevant here. I continued to think about investing until the very end. I was working in the months before I died on a revised formula for valuing stocks, 10 factors, distilled from everything I had learned, designed to be simple enough that any careful investor could apply them without needing my particular background. The intellectual engagement never stopped. I did not retreat from thinking. What I retreated from was the obligation to perform, to justify, to answer to others for what I held and why. That is a different thing. The point I am making is not that you should stop investing, The point is that the form your investing takes, the risk level, the time you spend on it, the degree to which your portfolio's daily movements affect your mood and your sense of yourself, that form can and perhaps should change after 50 and again after 65. Not because you have become less capable, because your circumstances have changed and an intelligent investor adjusts to circumstances. I do not say this to romanticize retreat. The decades on Wall Street produced things that genuinely mattered, a framework still used by serious investors today, students who build on those ideas in ways I never anticipated, books still being argued about in classrooms I will never see. I would not give those decades back. But the same drive that builds something can prevent you from knowing when the building is done. The market will always offer one more trade. That is its permanent character and its great seduction. There is always another opportunity, another mispriced business, another moment when the analysis says the price is wrong and the patient investor will be rewarded for seeing what the crowd has missed. That is true. It will remain true. The opportunity does not disappear. The question is simply whether you are investing your money or whether you have begun, without quite noticing, to invest your life. I want to be clear that I am not describing this as a failing. The investor who has remained engaged and disciplined and intellectually alive through decades of markets has done something genuinely admirable. The drive that produces that consistency is not a character flaw to be corrected. It is, in fact, a virtue, one that served you and will continue to serve you. But virtues have their appropriate domains. The discipline that makes a great investor does not automatically make a wise steward of the second half of a life. Those are related skills, but they are not identical. And the investor who applies the same orientation, maximize, accumulate, compete, measure to the years after 60 may find, as I did, that the very qualities that built the portfolio have prevented something else from being built. I am not speaking in abstractions, and I am not speaking as someone who resolved this perfectly. I spent years in my Beverly Hills study in a back room, largely inaccessible to my own family. My son, years later, described me as preoccupied. That is a kind word for what I was. I was present in the body and absent in every other way that matters. Not because I was cruel or indifferent, but because I had built a life organized entirely around one kind of output, and I had never seriously asked whether that organization still fit who I wanted to be. The market did not ask me to do that. I chose it. And I'm telling you, in case it is useful, that I did not recognize the choice until it had been made for a very long time. You have time that I did not use well. Perhaps that is the most direct thing I can offer you tonight. I spent 42 years learning to calculate what a business was worth. It took me until 62 to begin calculating what a year was worth. I am not sure I would recommend waiting quite that long.